OptionChampion.com.
Today is Saturday, March 18th. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications, nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to Tricks of the Trade on this Saturday, coming off of a very wild week in the equities markets. As many of you may have heard by now, Silicon Valley Bank, a Santa Clara, California-based financial institution that served nearly half of all venture-backed tech startups, failed on March 10th and was taken over by the FDIC. 2 days later, on March 12th, Signature Bank, a New York-based full-service financial institution, also collapsed and was taken over by the FDIC. These failures led to a fear of contagion that triggered a massive sell-off in a number of bank stocks. Silicon Valley Bank stock had been halted down by more than 60%, and Signature Bank stock had lost as much as 41% in 2 trading sessions. First Republic Bank had lost nearly 83%, Western Alliance 90%, and PacWest 81%. Widespread panic sent the cash market indices on a roller coaster ride. The Dow lost 48 points on the week, the S&P 500 gained 55, the NASDAQ Composite gained 491, the Russell lost 47, and volatility gained 71 cents. Crude oil lost $10.33 on the week. Gold was certainly the flight to safety this week with all the turmoil with the banks, rallying $121 an ounce. Silver gained $2.14, and natural gas ended the week lower by 11 cents. As fear hit the financial services stocks, it brought forth a wave of volatility, and that meant trading opportunities. One of those stocks was Ally Financial. While stocks were getting pummeled on Monday the 13th, Ally stock's one-day implied volatility increased 114%. Its 13-week implied volatility, not surprisingly, was at 100%, and its 52-week implied volatility rank, or IVR, was at 79. To take advantage of the volatility expansion, I sold the 15 put in April with 39 days to expiration at $1.40. Later on that same day, Ally's one-day implied volatility had decreased by 40% from the time that I put the trade on, and its 52-week IVR had fallen to 61 after rising to a high of 83. With that contraction in volatility, I closed the position at 80 cents for a net profit of 60 cents per share. Unrelated to banks, other positions include ZIM Integrated Shipping Services, symbol ZIM. I have on a short put vertical spread in April with 35 days to expiration, and at the time of the trade, ZIM had a one-day implied volatility increase of 78.4% with a 13-week implied volatility of 100% and a 52-week implied volatility rank of 80. The vertical spread is $2.50 wide with a short 20 put and long 17.5 put, and I received a credit of $1.54 per share on the trade. My profit is limited to the credit received, and the most that I can lose is the $2.50 spread minus the $1.54 credit received, which comes out to 96 cents per share. C3AI, symbol AI, is a long put vertical spread. The stock had a one-day implied volatility decrease of 6.1%, 13-week implied volatility of 52%, and 52-week implied volatility rank of 24. Hoping for volatility expansion in the stock, I bought a $2.50 wide vertical spread in April with 35 days to expiration. I bought the 20 put and sold the 17.5 put for a net debit of $1.06. Max profit is $1.44 per share on the trade, and the max loss is the $1.06 debit paid. And finally, Pure Storage, symbol PSTG, began as a collar spread on March 1st. A collar spread is comprised of long stock, a short out-of-the-money call, and a long out-of-the-money put. The short call and long put strikes wrap around the underlying stock price, hence collar, and benefit from a decline in the underlying stock price. The option legs are usually put on for a credit, though in some cases they might be put on for a small debit. The idea behind a collar strategy is to use the premium received from the short call to finance the cost of buying the long put and keep the remaining credit to reduce the cost basis on the long stock. One important advantage of a collar strategy is that the long put leg provides downside protection, or a hedge, against the long stock position by limiting a loss to the difference between the long put strike and the price paid to buy the stock. PSTG had a 13-week implied volatility of 98% and a 52-week implied volatility rank of 54. I bought the stock for $28.85 per share, then sold the 29 call and bought the 25 put for a credit of $1.15 per share. Both options were in the March cycle with 16 days to expiration. A day after opening this position, Pure Storage stock price fell to $25.35 per share. So I closed the short call and long put for a net profit of $1.72 per share, and then added shares to the long stock position to reduce my cost basis from the initial $28.85 to $26.52. And then yesterday, I went into the April cycle with 35 days to expiration and sold the 27 call 2 times and bought the 24 put 1 time, making this a 2-by-1 where I'm short 2 calls and long 1 put for a very small debit of 10 cents on the trade. If the stock price continues to slide, I'll close the 2-by-1 for a profit, add more shares to the long stock, and then wrap a new collar position around it. If the stock price rises beyond the 27 strike of the short call, I'll allow shares to be called away from the 2 short calls and sell my remaining shares, and then this entire position will be done. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.